what is market structure and how can you use external market structure in your trades. The way I look at market structure is just smaller trends being swallowed or consumed by bigger trends constantly. It's kind of like this. It's quite literally just the smaller trends reaching a point within a larger trend where it adheres to the larger trend. So I just kind of look at market structure as smaller moves being swallowed. That's the easiest way to look at it. And when you look at it that way, you realize that all market structure is both internal and external. If we look at this trend right here, we obviously have the external trend, and then we have the smaller trends that make up that overall trend. So that would be internal structure. This would be external structure. But internal and external, those labels are completely relative. The second I do something like this, it now becomes evident that this trend right here is just internal to a larger overall bearish trend. And that goes on virtually infinitely, right? Functionally, it's infinite. Now, if you go low time frame enough, and I'm talking like 100 millisecond, 200 millisecond candles, that's where market structure would begin to break down. And so it technically isn't infinite. You'd get into kind of order book stuff and microstructure at that level. But functionally speaking, internal and external market structure is infinite. The market's fractal. So yeah, you can essentially see it as all market structure being both internal and external, depending on what you compare it to. Now, how can we use this knowledge? Well, it basically tells us how long you can expect the current trend to continue and where you can expect price to go next. So if we look at this right here, let's say that this overall external trend that I have circled is the high time frame. Let's say the green trend is the middle time frame, and let's say this lighter purple trend is the low time frame. Now, if we weren't looking at external structure whatsoever, let's say we were just looking at the low time frame, just looking at this purple structure that I have circled right here, you'd kind of be looking for buys on a pullback. But if you zoom out and you look at the middle time frame, you see that within this green trend here, based off of how we've been moving, we're at a point where you'd expect a pullback. But then you can also zoom out to the next external structure, the high time frame, and see that relative to how we've been moving on the high time frame, we're also at a point where you could expect a reversal. So it's honestly really easy to get caught taking buys if you have tunnel vision. And I mean, it happens to everyone, but that's why it's important to zoom out, right? If you aren't sure about direction, zoom out and just look at the next external. Let's say you're just looking at the middle time frame, you're unsure, zoom out, look at the next external. Whenever you're unsure, just zoom out and look at the structure, and that'll help you a lot. Now, that's why it's so powerful to connect market structure with candle behavior. The best trades are always at a point within market structure where price is likely to imminently shift direction. Example being this little circled low time frame structure here that we just went over. And we're also at a point in time within a candle's lifespan where you can expect a reverse. Now, let's say that an hourly candle opens right here, immediately drives bullish. Let's say 30 minutes in, we're right here. The next 15-minute candle opens, immediately drives bullish. Let's say that we're 5 minutes into that 15-minute candle. A new 5-minute candle opens, immediately drives bullish, and we're now right here. So now we're stacking the candle timing. Obviously, this graphic looks absolutely brutal at this point, but we're now stacking candle timing with where we are within this middle time frame green trend. We're also stacking it with where we are within this external high time frame trend. So if you can put all those pieces together, that is when the highest probability trades happen. Now it just comes down to the low time frame, which is where you really have two options. One is you wait for the low time frame context or the low time frame character that brought us to the point within market structure that we're at. Let's just get rid of all this for simplification. All right, so we have this lighter purple structure here. We're here. We are already at an area within market structure that makes sense, and we're already at a point within candle timing that makes sense, right? We're second half of the hour, we're second half of the 15-minute candle, and we are second half of the 5-minute candle. Really, the last step is correctly interpreting the low time frame. So there are a couple of options here. One, we can wait for the context that brought us to this point within market structure to break, and then maybe you're entering on a pullback for a nice sell. That's option one. I mean, it's arguable what the better option is. It kind of just depends on the condition. But the next option would be, so we're moving like this. The next option would be trading while we still have room to move within the structure that brought us to this point and not presuming the break of it. So this works really well with overextensions. Let's say that the 15-minute candle opens here, and instead of continuing how we've been moving, let's say we just overextend. At that point, you don't really need to wait for a break of this low to get a solid scalp. You can actually take a trade that simply doesn't presume the break, right? You have room to move, and that would be a solid entry as well. So yeah, you connect all those pieces together. That's how you use market structure, and it's really just a matter of taking this model and correctly applying it to price action, because obviously market structure doesn't look this clean, but you can use the exact same logic on market structure. It's just a matter of picking it out. That's literally all it comes down to. Now, it's important to note that if you are taking an entry off of an overextension like this, you are still waiting for a break to some extent. You're not just blindly firing while price is actively moving bullish here. You're waiting for the character that got us up to this point within the overextension to break, as opposed to this overall low time frame character to break. It's more of like a low time frame break than a low time frame break. This would be kind of like a high-low entry, right? We have a high volume candle sequence in here, and then you'd get the break of a 1 minute candle to the upside, followed by an immediate break of a low, and you'd enter there. So you're still waiting for a break. It's just that what constitutes a break is a little bit more lenient than it would be if we were moving more structurally. All right, I just want to go over a tip and a quick example of what I'm talking about. So the biggest tip that I have is that rigidly defining timeframes can actually work to your demise. Now, obviously, labeling durations of price like high time frame, middle time frame, low time frame is useful for classification, for journaling, for finding similar conditions and kind of basing how you're going to perceive price off of previous sessions. But as for when it comes to the decision to take a trade itself, the decision should be based off of what you're actually seeing with your own eyes, what structure actually looks like, as opposed to kind of throwing these labels into an equation and using that, right? Example would be high time frame bullish, middle time frame bullish, low time frame bullish. Okay, like I'm looking for buys. You need to actually look at the structure itself as opposed to doing this, or you're going to lose information. It kind of reminds me of a quote that I saw on this like little philosophy Instagram page. I think it is, I'm trying to remember it. It's something like, you tell a kid the name of a bird and he never sees that bird again. As in, you tell a kid what a bird is and he no longer sees the creature itself. He just sees it as a bird and there's no further analyzation. It's very similar to market structure, right? We often fall into the trap of labeling the high time frame as bullish, and all of a sudden you don't really see the structure. You just see the high time frame as bullish, and you're using that in your equation to come to a decision to make your trade, as opposed to what the actual structure is telling you. This is actually a perfect example. I think I have this trade recapped from about a week ago, but in this situation here, overall high time frame equals bullish, right? We're clearly trending bullish. If we zoom in here, we also have the high middle time frame generally pushing bullish, middle time frame pushing bullish as well. So it's like what? Like all these time frames are aligning. I should be looking for buys. The issue arises with the fact that you're losing sight of this huge bearish shift because you're rigidly defining the market structure. Whenever you try to define something that's in constant fluid change, you're going to end up losing information to some degree. Like, yes, technically, if you zoom out, high time frame is bullish, right? Last 24 hours or so are technically bullish. And we've also technically been pushing bullish the last 12 hours or so. And we've also technically been pushing bullish the last, 4 to 6 hours or so. But you're losing sight of the fact that we're within this bearish external move. We're very, very close to the top of it. We have this large overextension here, right? Lots of room to move within this overall high middle time frame trend without violating it. So looking for buys up here is structurally a mistake. There are definitely opportunities, candle behavior wise and whatnot, to catch quick reactions. But if you're looking to use structure to increase the probability of your entry, buys up here just simply aren't the move. Even though, right, if you go through the rigid definitions, high time frame equals bullish, MTF equals bullish, LTF equals bullish. It looks like you have full market structure alignment. You actually don't. And in fact, this is like perfectly aligned for sells. So just little things like that. That's where internal and external structure can help you. And yeah, obviously structure isn't always going to look, it isn't going to look like this very often, but you simply need to get good at applying this sort of logic to structure that looks imperfect. And that's how I use internal and external structure. Maybe I can break it down in more detail or better, honestly, if I watch this video a few times, and I'll probably realize things that I missed, but I'll leave it there for now. If you have any questions or you think that I explained this poorly, then let me know, because I'm trying to get better.